Zach.
Hey Scott, thanks for joining today.
Yeah, I am catching up on some of the Celsius news today and reading about some of their liquidity trading or being stored on these blockchains like Beacon and Lido. And I'm still kind of a layman in this field, but I'm just curious. Like one of the questions I have is if they're keeping so much of their reserve liquidity on these what seem to be fairly new and unproven blockchains. Like, why is that? Why are these blockchains getting so much use and there's no real test or validation of how credible they are? And then secondly, Celsius, I'm just interested in your comments on what might happen there and how it's becoming like a weekly, bi-weekly sort of issue that could accelerate, where you have major pockets of significant amounts of capital sort of just melting down through bank runs, more or less.
Yeah, well, really good question, Scott. Thanks for chiming in. So to start with your first question, why are people speculating on these kind of like DeFi protocols that really have like kind of early stage venture equity risk, but are promising more like type of bank insolvency risks? I think it largely comes down to the fact that most humans and even professional investors are kind of lazy and greedy. And we've seen this in time and time throughout history, where if there's a promise of an easy return, many investors will go to that. So there's no shortage of examples in history where not just kind of retail investors, but supposedly the smartest, most sophisticated institutional investors invest again and again in things that promise kind of a risk-free or close to risk-free 8, 10, 15, 20%. But you always have to ask yourself, where does that, percent come from? How are people earning that? So typically, in DeFi, what we see is it's coming from one of two ways. One, where it's coming from like venture capitalists as effectively a customer acquisition cost. So they're paying some type of return, and that's coming out of a limited pool of effectively venture dollars to, scale or grow this ecosystem. And while that's maybe unsustainable, perhaps the argument is that can get them to a place where then they're able to sustainably offer that. I haven't seen a single example of one that's actually happened, so I'm quite skeptical on that model. But and then the rest is basically hidden risk, and that's where like whatever outside of the venture dollars, that's maybe 95, 99% of where these returns are coming from. So you saw this recently with kind of the Luna and UST collapse. I personally had friends that in many areas of their lives, they're quite sophisticated, quite intelligent, and they had money in Anchor because, they were told by their smart crypto friends that have made a lot of money in DeFi that, Anchor is kind of the best place to put your cash. Like, why keep it in a bank account? You could put it in Anchor and earn, 18, 20%. So I think, you had these people where they heard it from other folks and they didn't properly do their diligence. And this is, not a new story, just kind of a new flavor with kind of crypto and DeFi today. So, we've already seen, assets move directly from Celsius to other things that promise 20 and 30% returns. So, some people will just kind of never learn the lesson. And for many people, they're kind of learning their lesson with these types of schemes for the first time within crypto and DeFi. So that's, I'd say, just broad strokes, lots and lots of hidden risk. And anyone that promises you a stable, 5+% return in DeFi, you have to understand, where that comes from. And if someone can't tell you clearly where that comes from, spoiler alert, no one can, then you should, I think, stay far away. So, and we've been, saying this publicly throughout kind of the rise of, DeFi, and it's been really sad because what's, so much smart people and capital going into what they think is the future of finance is actually just kind of a repeating of what we've seen before that isn't really making anyone more money, isn't changing the future of finance, kind of just shuffling money around within a negative sum game. So to your second question, specifically on Celsius, I haven't spent enough time to have like really high conviction on what is happening, but it seems incredibly likely that they are insolvent. Things that I've said, I believe publicly, if not just to many people in conversations, that companies like Celsius and BlockFi represent some of the worst risk-adjusted return bets in the crypto space. As there's just really clear kind of public lines where if crypto assets get to that place, there's automatic liquidations. So we're seeing this playing out with Celsius, where they're adding more collateral, so that number is going down. But in the past in traditional finance, some sharps or hedge fund insiders might know where someone else's kind of breaking point is in terms of margin calls. In crypto, that's kind of basically all public in a way that's never been possible before, which makes it, I think, more likely that these kind of like wicks down to liquidate people occur. And if you look at kind of the history of just retail trading in terms of using leverage, you see that all the time where basically because these blockchains are largely public, you can figure out where these liquidation prices are. And if you're a sharp person, you can basically wick it down and make a nice return through a variety of different methods. Nothing really particularly new or novel to crypto. We've seen that in kind of liquid markets and equities and bonds for some kind of the history of modern finance. So I'd say Celsius is very likely insolvent, and I would probably expect them to get liquidated, but I don't have particularly high conviction in that. I'd say that's just like more likely than not. I would want to do more research and diligence to form a view, but because that's not really relevant to our portfolio companies and what we're doing, while it's quite interesting to me, I haven't put the time in to develop that high conviction view. Jack, it looks like you want to chime in here.
I wanted to just ask Scott, can you repeat part of your question about some of the specific blockchains that they were using that you were asking about?
Yeah, I just started reading about it this morning. So like Beacon and Lido, and I remember the Terra, like half the volume was on some blockchain that like had no other trading other than Terra, which I forgot the name of it. It just strikes me as like if everyone decided to go bank with their cousin down the street instead of Bank of America, and it turned out badly, and then you were surprised. I'm shocked that some of these blockchains that don't seem to have any third-party credibility points are getting so much volume. And I know they're promising above market interest rates to drive the deposits, and one's feeding the next, feeding the next, which was kind of my follow-on question, is like, how much risk of this happening, on a faster pace going forward do you all believe exists?
One thing I just want to highlight that's related to that question, I can't speak on the specifics for Celsius, but something that we've observed a lot at Unbounded Capital, in which I've observed through a sales capacity at Nifty Jigs, which is a company that I started in the NFT space, is that it's extremely common, when you're choosing what blockchain to build on or utilize, that there is some kind of transfer of tokens that incentivizes you to choose some specific solution. So when you're talking about Celsius, I'd imagine that there's a lot of protocols who are willing to give a lot of their tokens to someone like Celsius in return for using their service, because they can then obviously market that. Celsius can either hold or dump those tokens based on the sort of headline of, hey, Celsius is now using this new protocol. Look at, what's happening with the price of that token now. And this is something that actually kind of ripples down. I mean, Celsius is obviously a very large player in the DeFi space, kind of a big name, a big get. But even for smaller projects, so often when they're choosing, like, what blockchain am I going to build on? People come to us, they're interested in BSV, but they're expecting that there's going to be some amount of money from like the Bitcoin Association, or a lot of blockchains, they have this like big treasury of their own native token that's reserved for the foundation of that specific blockchain, and the foundation typically uses that to try and recruit projects. I'm not saying it's a bad model, but BSV doesn't have that. There is no reserve of BSV or reserve of Bitcoin that's used to entice projects. And so very often, it's an uphill sales battle, because you're competing against a blockchain that can offer like $1 million, $2 million or more of investment on top, like if you choose that chain. But I also think that's going to actually affect companies who've taken that deal, especially during this downturn, because I don't think it's very common to immediately liquidate that type of insurgence of tokens into USD. I think there's very much like a HODL mentality amongst a lot of entrepreneurs in the crypto space. So I do think that the working capital of a lot of blockchain startups, especially those who have received large amounts of crypto through these blockchain foundations as part of their like seed capital, are going to find themselves, with a lot less runway than they had expected.
Yeah, not much for me to really add there. Thank you, Scott. Does anyone else have any questions at this time?
Hey, Zach, it's Tim here. Can you hear me?
Yeah, hey, Tim.
So I'm just curious, I think, do you feel relative to like other venture firms out there, how you're positioned? I think you really, from what I understand, you don't really have exposure to, sort of speculative crypto assets, tokens, et cetera, right? So, relative to how you're positioned, your portfolio, you touched on it in the beginning. I think just walk us through, I guess, what you feel like your exposure is through, at least current as well as pipeline of, you don't currently have exposure other than, I guess, maybe you have some BSV exposure. And I don't know if you want to touch on how you look at that as versus, portfolio companies as risk reward, at today's prices. But, maybe if you want to touch on that, I guess, with the downturn and everything.
Yeah, so I would say the company that has like the most exposure today is TDXP, recently rebranded as DXS. So for those of you not familiar with this company, I'll just drop a link to it in the chat here. What they do is they leverage the Bitcoin SV blockchain to provide the ability for folks around the world to invest in US equities and US equity derivatives in increments as low as 1 cent. And because of the Bitcoin SV median transaction fee of 1/1000th of a penny, they're actually able to make a decent, gross margin off trades and investments as low as 1 cent, and some are much higher than that, of course. So most of their users today are in Indonesia and Nigeria, and they're focused on the emerging markets where there's billions of people in the world today that live on less than $20 a month. So because of basically limitations within the Bitcoin SV ecosystem today that will likely be solved in probably 3 to 9 months, I would estimate, to use TDXP and invest in US equities, you have to have some typically second order, sometimes first order exposure to Bitcoin SV itself. And a lot of the early adopters were really big fans of Bitcoin SV. Well, now most of their users are just kind of coming there to invest in US equities. So they're probably most exposed to the kind of broader crypto market downturn, as the price of BSV is quite low. But I would say that, that's kind of the most exposure, but really most of their users are not going to TDXP to speculate on BSV or different types of crypto. They're going there to invest in US equities. And again, in 3 to 9 months, we expect there to be, a TDXP solution, other solutions within the ecosystem. We actually have one of our portfolio company founders on the call today, Alex, that will hopefully have an exciting announcement within the coming months around that, where you could effectively use BSV and never have to take on BSV token exposure due to stable coins or actually directly US dollars on the protocol. So I'd say that's the biggest exposure, and that's fairly minor. And then we don't have another portfolio company that has anywhere near close to that exposure. Other portfolio companies are just solving problems and putting data, putting payments on the BSV blockchain, and obfuscating any usage of the blockchain or exposure to the price of BSV to their customers and users. So that's kind of where Unbounded sits today in terms of Fund 1 portfolio companies, and there isn't a company in the pipeline for Fund 2 that we have. And just for folks, I know we have a lot of, I think, first-time participants today. Our Fund 1 closed end of last year, basically fully deployed. Our Fund 2 will be launching very shortly. Our first close is tomorrow, and we'll be deploying capital from that first close in early to mid-July. So in that pipeline of companies, there's no one that has any exposure to kind of the broader crypto market today whatsoever. If you look at other blockchain VCs, I'm not aware of another VC fund that doesn't have significant exposure. I'd say the one that's probably closest in terms of how we think, but still with some really huge differences, is Castle Island Ventures. They're really into infrastructure for companies using public blockchains. They're primarily focused on BTC and Ethereum, though, the two, the least scalable public blockchains in the world, and the two transaction processing systems that are the least efficient in the entire world. So, more energy, more costs for processing transactions on those networks than any other network, whether blockchain or otherwise. So I know that definitely some of their companies have zero exposure and they don't invest in any tokens, but both of them still have very significant exposure to the price of BTC and Ethereum. If there are other, VC funds that I'm not aware of that, invest in blockchain and crypto companies that don't have meaningful exposure, I would love to connect with them, but I've searched hard to try to find them, and I'm not aware of others today. So hope that answers the question, Tim, and happy to answer any follow-up.
Yeah, no, that that was great. Actually, just coming back, because the whole Celsius thing, I mean, I personally have I'm not as well versed in this whole space as well, the whole staking businesses and the free yields that have been offered. But I think you said something which is entirely true and holds true. It's like the idea of if someone's offering you anything more than, let's say, 5%, I mean, much less 15+% risk-free return, if it sounds too good to be true, it usually is. And do you see other, I mean, I think this is the deleveraging, which you and I have talked about. There's a group it's a company called Genesis Block where I met them, and I actually tried to have them walk me through the custody of a dollar from $1 to more than $1 and how that took place. And it was, these were younger guys, but it was very, very, they just weren't able to sort of answer that question, how they turned a dollar into more than a dollar. So I don't know, I didn't have Luna exposure otherwise, but clearly if someone's paying 20% for anything, it's because they think something has to go up much more than that elsewhere. And with everything that's gone on now, do you see, like, coming back, like second, third order repercussions? Do you see the next Celsius or the next Luna, and what do you think that effect will be? And I'm just kind of curious, like, because it seems like this is probably, they're going to be more repercussions for the moves that are taking place today, including in just the public equity market, right? Like the sort of deleveraging that's taking place.
Yeah, I mean, I think that's kind of the multi-billion-dollar question here in terms of what that's actually going to be and how that's going to happen. We've said publicly for years now that we think Tether will have an unraveling at some point. There's a lot of really smart people that are spending much more time and capital on trying to solve that problem. So I don't think we have an edge in terms of figuring out the timing of when that might happen. And a lot of it comes down to doing a lot of not due diligence without public information to try to find like what they're not insider trading, but just like doing stuff that Tether doesn't publicly say around where their collateral and US dollar equivalents are. So Tether has admitted publicly that at one point they basically were running a Ponzi scheme where they had 20% of all deposits on hand. We know that at other points during bull markets they've had like well over 100%, and ultimately the folks at Tether, what they're doing is they're running this kind of incredibly speculative hedge fund and offering it as like a money market or stablecoin type thing. So while perhaps they even today might be, solvent or close to solvent, given just everything they've done in the past, the extreme risk profile they've had in the history of, lying to the public and never, doing an audit, we have a lot of confidence that they're going to, be insolvent and not already, fairly insolvent today, and that, there will be an unraveling. So I would expect that to happen, and that, at some point in the next few years. It could definitely be quite soon. But I don't really feel personally like we have an edge in determining when that is. But yeah, I'd say that's probably one of the biggest things that could really affect global markets. I would say I have pretty high conviction when Tether unravels, there will be like widespread, broader market implications for that. And I think arguably the unraveling or potential soon to be unraveling of Celsius and other crypto networks like Luna and Terra have had actually major impacts on broader markets today. We have some smart hedge fund people on the call today, so it would be curious for those folks' opinions from what they've looked into, looking at kind of recent market moves and how correlated they are to various like liquidations of different DeFi protocols today. What I've been saying for a while, Tim, I believe we've talked about this, which is, I've said kind of like BlockFi, Celsius, these are some of the worst risk reward companies like Unchained, where there's some number where their business just goes belly up if Bitcoin goes down enough. So I think finding businesses like that, those are kind of the ones that are most likely to be next. So I'd say like, a BlockFi, an XO, those are companies that are likely to be next. Perhaps I would bet on those, like a consortium of those, before I'd bet on, say, Tether unraveling.
Thanks.
Yeah, Joel, thanks for the comment there. And just to provide a little more color on like Tether and exchanges. So we've seen this, a bunch, and there's a lot of smart people have written great articles on this. But effectively, Tether will give away free tethers that are likely unbacked and they're just creating out of thin air to exchanges. And really, it's the USDT and not like a US dollar or USDC peg that drives kind of global, Bitcoin price and Ethereum price. So yeah, there's definitely, I would bet that a ton of crypto exchanges, definitely like Binance, a lot of the major ones, Binance, of course, the biggest one in the world today, that are not fully solvent and using customer funds to potentially even trade against their own customers. We know with certainty that in the past, funds like what's Arthur Hayes's someone help me here.
BitMEX.
Yeah, BitMEX. So we know that BitMEX has like used information to trade against their customers in the past with certainty, and I've seen reports of why it's highly likely like Binance and Huobi and others have done this before as well. Yeah, I definitely think contagion from exchanges could happen, especially exchanges that are in bed with Celsius, which we know Binance is to some degree. So again, there's kind of endless amounts of diligence to be done here. And yeah, don't have high conviction on which of those exchanges, as I'm not, working on that problem full time. But for anyone that is interested in that, that's where I would kind of start, which is the exchanges and kind of the yield and credit companies like the BlockFi, the Nexos. Okay, we have a question here from Mark Overly. Can you comment on how crypto custody works in general with a firm like Fireblocks, and how CryptoVol potentially affects their solvency and client assets? So what I would say is, if you're working with a dedicated custodian where that's all that they do, my understanding is that there's no like serious insolvency risk. Of course, I think there's probably just likely more insolvency risk with a company like that than with a traditional institutional custody solution that also does crypto, rather than like a crypto native firm like them. But yeah, I think that's typically how it works. It's not too different from normal custody. We've used, a couple different custodians over the years, and, we send them crypto, and, all the terms are that they can't trade that around unless we give them explicit permission to. So I would expect significantly less risk with a dedicated custodian, although still some, compared to folks that also offer the ability, custodianship, but maybe their T's and C's are something like what Celsius or BlockFi has, which is, ultimately in the event of insolvency or liquidation, customer funds, come, really at the bottom of the stack in bankruptcy. Jack or Dave, anything y'all want to add just on the conversation? We wait for some more questions here.
Yeah, I'm happy to. I wish we could have another question. I've got a filler next time we're without one.
Hey, Zach, it's Francesca. My question is, are there any winners in this sort of market scenario that you want to highlight? Is anybody doing great work right now?
Yeah, thanks, Francesca. I mean, we actually have, one of the companies I was going to highlight, we have the founder on the call today. So rather than me kind of share, Alex, if you're in a position to share a little bit about what Hinkash's been up to, the USDC announcement, give maybe a brief kind of 1-minute update. That would be awesome. If you're not in a position to give it, I will do my best on your behalf. Okay, I'm going to start with another company, and then we'll see if Alex is available. So so one company is called Run. So today what they do is they're a smart contracting, smart object NFT platform that takes advantage of the Bitcoin SV blockchain. And today, they've had days where they process 18 million transactions. So to put that in perspective, the BTC version of Bitcoin does a few 100,000 per day. Ethereum does about 1 million. Solana claims to do as high as like 100 million, but really 90 to 95% are like spam voting transactions. If one of our partners can link to our research we recently put out, if you want to learn more, Dave or Jack will drop that in the chat in a moment. And yeah, they, despite the fact that a lot of their comps are valued in the many billions or hundreds of billions, they today, we invested in them at a very low and I think good and reasonable valuation as recently as early this year. Intend to make additional investments out of Fund 2, shortly into this company. And yeah, their problem has not been capital for a long period of time. Their problem is basically just hiring the right people and keeping up with user and customer demand. So really proud of what Brenton and Run have accomplished to date. And yeah, excited for their continued growth that is just independent of prices of crypto, and it's just about serving customers and helping them put data on a public ledger really efficiently. So brief overview of Run. And Alex, you want to share a minute or so about what Handcash is doing lately?
Yeah, sure. Hello, everybody. I cannot turn on the camera. I mean, I have very, very bad lighting conditions today. So anyway, excuse me for that. So one of the things that we are working on, as Zach has been explaining, is through a partnership with Circle. We are going to be issuing not USDC on top of BSV natively, but we are going to have the equivalent tokens running on BSV. So basically, we are going to be able to offer through our SDK that companies are using right now, the ability to move basically dollars on top of BSV. So this is a huge deal for us. We have a lot of companies that really like the technology, they like the performance and the business models they can create. But ultimately they say, okay, this is great. Call me back when you are able to move US dollars or BTC with this. So at least with this technology, we can solve that with any asset that we want with the same technology. So we are very optimistic about this. I think it's going to be a huge, I think it's going to be a success. We are talking about, we are talking with newspapers here in Spain, for example, where it seems like the newspaper industry is reliant on subscriptions, but it's not something that's working for them. So what they do is that they have a combination on filling the websites with advertisements and selling your data, and also asking you for a subscription for premium articles. So the thing is that right now the distribution model for newspaper articles goes through social media, especially things like Twitter, right? So the typical use case is that you go, you see a very interesting article on Twitter, you click, then you go to their website and you spend like 10 seconds waiting until everything loads. And when you are about to read and you scroll a little bit, then something pops up and says, hey, if you want to read this article, subscribe to the New York Times or whatever. So it's like $9.99 per month, subscribe for a year. And I just want to read the article. So right now they're leaving money on the table because they don't have any option of saying like, okay, just pay me 10 or 20 cents and I will get rid of all the advertisements and you can read the article. So I think there's a huge business opportunity for adding, not necessarily for replacing existing business models for many companies, because they're very afraid of this, of doing something very radical. But the cool thing is that you can add complementary ways of adding new revenue streams, and a lot of companies are very open to this. But again, this is something that you cannot do if you are limiting companies to accept BSV, because even though it works, they know that the BSV market is very small and they're not very interested in that.
Thanks, Alex, and thanks for the question, Francesco. We could definitely talk all day about some kind of highlights in our portfolio and what we're seeing in the world that are independent from crypto speculation. We'll leave it for a few more questions to be asked before we just maybe highlight a few more of those. Thanks, Francesco.
I can add something very quickly on Francesca's question, because I think what was implied in our answer is that, and this is something that I definitely do believe, companies that can offer real value today, I think, are the winners. And the reason is not because they couldn't offer real value yesterday and they can today. Those businesses haven't really changed. They weren't necessarily affected by this market crash. But I think that what does impact these companies is that with kind of the air coming out of the bubble, you have a lot less attention, both from like an investment standpoint, as well as just a consumer interest or media standpoint, in projects that are really kind of tied into, with their success, this speculative bubble. And you have a lot more capital, attention, availability of talent, for example, that can go into these companies that can really offer value today, independent of that speculative use case. And so I think that it presents a new opportunity for kind of like a new type of crypto company to emerge at the forefront of what we think about when we think about blockchain.
Thanks, Jackson.